Hello, Pro Crypto. RB Phil. With us today, we have the two founders of Genesis Volatility, Pat Doyle and Greg Magadini. It's a pleasure to have you both on today.
Yeah, thanks a lot. Super excited to be here. Excited to talk about our tools and our background and how to think through volatility trading and some of the data points that some of the Real Vision users can use in their own trading.
Yeah,
Great.
Super excited to be here. Thanks, Phil.
Absolutely. And just a heads up before we dive into your questions, Pat and Greg are going to give us a tutorial of the Genesis Volatility platform. And if you have any questions or comments on the platform, just drop them in the feedback channel of Discord, and we'll be sure to get them over to Pat and Greg. You guys can take it from here.
Yeah, perfect. So just to kind of give a quick background about Pat and myself. So I've been in the crypto space. I got started around 2013 is when I first invested in Bitcoin and really started following the space. My background is as a proprietary trader. So I was a trader. I got started at S&B Capital in New York, and then Chopper Trading in Chicago, and then DRW in Chicago. And then in late 2015, I actually left DRW to just trade crypto on my own. And I had been doing that pretty much up until launching Genesis Volatility with Pat. And so Pat and I met in 2015. Pat, do you just want to kind of touch on your background briefly?
Yeah, sure. So my background was in data science. As soon as I met Greg, he introduced me to Ethereum, and that was back in 2015 when I was kind of bitten by the crypto bug. So I always had a background as more from the engineering perspective. So ever since Greg and I met, I've just kind of been building products in this space, specifically from like a data perspective. So we saw an opportunity kind of in the larger crypto derivatives market to build tools that help traders. And so that's kind of when we kicked it off.
So we see a lot of opportunity in crypto options. It's still like a very nascent space, and that creates like a even playing field in a way. Like if you think about trading, call it crude vol or equity vol, there's people who've been in that space for 50 years. Banks have been in that space since the start, since options started trading on CBOE in 73. In crypto, the crypto vol space is pretty young. I mean, the first trades on Deribit were in late 2016, and we didn't really start seeing serious volume on Deribit until 2019. So at best, people have been trading crypto vol for about 3 years realistically. And so as far as kind of new entrants into the space, this space hasn't been figured out yet, so to speak. So there's a lot of opportunity out there. And I think just kind of looking at crypto vol from different angles can really help your trading. So I'm happy to just kind of jump into the app and maybe explain how I look at crypto vol. And then we could sort of take it from there. How does that sound?
Sounds great.
Perfect. So let me go ahead and share my screen. All righty. So here's the GVol app. So really kind of our focus on GVol is really looking at volatility, both implied and realized. And the way that I think about it is that there's a lot of traders will trade vol specifically. So like market makers will be purely targeting volatility trading, and they're delta hedging all the time. And your hedging algorithm is a really big component of your volatility trading. I would say that's a little bit, you have to have a lot of infrastructure to do that successfully. So that's a little bit outside of the scope of most traders. The way that I think about it is that if you're just a discretionary trader, layering volatility into your discretionary trading will really allow you to isolate expected value. So like just think about a portfolio. Like stock pickers will pick a bunch of different stocks. And if you're a really good analyst, in the long run, you'll be right. And having multiple stocks in your portfolio allows you to diversify. Well, layering volatility is sort of the same way. Like you can have an opinion on the direction of crypto going up or down. But then if you layer in an opinion on volatility as well, you're sort of like diversifying your bets, and you can minimize variance, isolate expected value. If you're right about vol, or if you're right about just direction, stuff like that, you can really get that down. And kind of a last component there is you can diversify your timing as well. So instead of getting all in and all out in one space, think about scaling into positions, scaling out of positions, using opinions on vol, using opinions on price, and putting everything together. If you're right about your analyses on average, you'll isolate a lot of that expected value. So when we're talking about crypto volatility, one of the first things that we want to look at is going to be sort of these, the implied volatility of options just in general. So let's say I look at Dval Index. So Dval is kind of the derivative version of the VIX index. And so for anyone who's new to options trading, VIX is a 30-day implied volatility across the whole strike surface. So the reason why that's an important distinction is because options will be priced differently depending how far out or far in the money they are. And they'll be priced differently depending on time until expiration. So the Dval gives you like this nice standard view, and you can expand it and kind of get an idea for it. So one of the things I've been looking at personally myself since May, we had this huge spike in Bitcoin volatility when the Luna peg broke and UST went all the way pretty much to zero and Luna went to zero. Then we had sort of this pullback down in implied volatility as this catalyst passed. And then we had this 3 arrows contagion effect that occurred shortly after. And now we're kind of pulling back here as well. So looking at those spikes up and sort of the retracement really gives you a good idea of like what vol can do and where we currently stand. We have some tools here that can help you annotate that. So let's say I just want to look at the high here and stick that bar here. If I want to look at sort of the low of the pullback, I can stick that here. And now we have this kind of intelligent range that we can play off of. Something else to look at is what we have here is the spot price here in pink. And so you can really see how is vol moving with spot prices. So here we saw that spot prices crash with that contagion effect, the 3 arrows effect, and vol spiked up a lot. So that's kind of a brief look at sort of where's vol trading, where can it go. Something else to look at is called the variance premium. So one of the things, if you think about options as insurance, you know, State Farm sells you fire insurance on your house. Well, the hope that State Farm has is that they collect more premiums from selling fire insurance than they pay out claims. And you can sort of think of the variance premium the same way. So the yellow line here is going to be the Dval Index. The blue line is going to be how is the underlying actually moving. And so how often, so to speak, do these insurance policies pay out? And so the difference between the two is the variance premium, or the extra price above the expected value. So when it's positive, options are overpriced. When it's negative, options are actually underpriced and option holders get paid out. So kind of looking at that average variance premium over time is another really good way to quantify if options in general are overpriced or underpriced, and in this given environment, where do they stand? So that's kind of the broad view. So one of the things that we'd like to do at GVol is also look at sort of the details of realized volatility. So if I go to the realized volatility tab here, there's a lot of different ways to break down realized volatility or how much the underlying moves. So we'll go ahead and look at that here right now. So let's say I'm looking at Bitcoin. We have all these coins that you can pick from. I'm going to go ahead and look at Bitcoin. There's a few interesting metrics here. So let's do the past 10 years, so to speak. So what I'll see here, and I'll just move this little camera real quick. So basically what we can see here is we've broken out up days versus down days. And what we do is call HV1, or historical volatility 1. So we use the Parkinson method, which is basically the high and the low with the diffusion index priced. So what you can think of it is if you have a high and a low as part of a distribution, you can sort of back out the mean from that, or excuse me, the standard deviation from that process. And so what that allows us to do is look at historical volatility for one day, but then annualize it. So the median on up days is about 49 realized volatility. The median on down days is about 53. And we can see the 90th percentile, 118 to 130. And then, you know, there's a few extreme days on up days and down days, up to 600, 477. On the lower side of the volatility spectrum, the 10th percentile is 20 to 19. And what traders will typically look at is called the interquartile. So it's going to be 75th percentage down to the 25th percentage interquartile, and that will tell you half the time where is volatility realistically. So this gives you a really good idea of what volatility can do. And so if you're looking at realized volatility, you can then compare it to implied volatility and see how expensive those options are priced. Something else to look at here is going to be realized volatility calculated with daily data versus monthly data. So if you're trading long-term options, one of the things that you want to keep in mind is that how the market trends is going to impact volatility a lot. So if you just conceptualize it briefly in your head, if the market day to day is moving up and down a lot, but at the end of the month, it sort of closes at where it started at the beginning of the month, prices will be sort of mean reverting, and therefore monthly volatility is going to be really low, but daily volatility is going to be really high. And then if prices are trending and you're seeing small but consistent trends day to day, while the monthly range is going to be really big, despite the daily range being sort of tight from day in, day out. So if you're trading longer term options, kind of looking at volatility calculated on a monthly data input as opposed to a daily data input, it's going to change your perspective a lot. So this chart will compare 30-day daily data versus monthly data, and you can sort of see that relationship between the two. One of the other things that we look at a lot is the volatility tone. So let me just put this 10 years back again. So I'm looking at Bitcoin realized volatility from August 9th, 2012 to basically today. Let me go ahead and kick out the maximum, the minimum, and just really look at that interquartile. So what I can see here is the upper 75th percentage of the distribution and the lower 25th. And we can see that really, call it 30-day, most of the time is between 53 and 96 vol with a median of 68. So that's really where you're going to see half the time you can see volatility over there. If I stick in the maximum and the minimum, we can see that in the past 12 years, we've had quite a few crazy days. That one day we've seen it 1,000 plus balls, so on and so forth. And then kind of over the year, or 180 days of realized volatility, the max we've seen is about 300. The min we've seen it is about 44. So this really gives you a good context of what realized volatility can do. And so there's a couple other cool things to look at when you're dissecting realized volatility and making projections on how expensive or cheap options are. So one of the other things is seasonality. So for whatever reason, summers tend to be less, there's a little bit less movement than, call it, the beginning of the year. So what we've seen here in the past 10 years is that Bitcoin, kind of the most volatile month over the past 10 years, has been February. And then it kind of dies down and plateaus out in August, September, October. So if you're trading vol right now, if we go back to sort of our analysis, we saw that Dval Index had a spike on Luna implosion, on 3AC contagion, and now it's kind of trending back down. And now we're going to the seasonality of August, September, and October, where the vol has typically been about 50 to 57. And so this gives you a really good idea of like, okay, what do we expect to happen? And then where are we priced right now? So these are the realized volatility tools that I like to base my initial thesis on. And now if I go to how options are priced right now, this is called implied volatility. I can go to Deribit, current order book, Bitcoin, and really get an idea of things, how are things priced right now. So if we look at something called the implied volatility surface, this is really going to show us, across all the options you can choose from, whether it's puts or calls, all the different strikes, all the different expirations, how are things priced right now? So one of the things that we like to look at is the different expirations. We can see here, there's a bunch of different expirations to pick from. And based on the strike price, the implied volatility is going to be a lot different. So if I could just compare, like, say this August 11th, you can see that the distribution is like very, very tight because it only has a couple days until expiration. And if I go out here to call it the March 2023, the distribution is a lot wider and it's kind of flatter implied volatility. So you'll notice that as time goes by, that smile shifts its shape a lot. So the smile is known as the skew, and it really calculates the difference for implied volatility for each different strike. So if I go down here, something that we've done is that we've created like a constant maturity skew. So what's really important there is that because skew shifts as expiration time until expiration changes, we want to normalize that, and we want to take out distinct time until expiration. Let me just expand this range a little bit just so we can get some more data here and really get a good view on it. So right now I'm looking at January 9th, 2022. to today in 4-hour increments. And what I have here is a constant 7-day, constant 30-day, 60-day, 90-day, 180 days. And what I'm looking at here is the 25 delta calls minus puts. So this is going to tell me the difference of how, if we're above zero, that means calls are more expensive. If we're below zero, that means puts are more expensive. And so what we're seeing here is that in June, during the Luna event, this was a Luna event, this was a 3 Arrows event, we could see that puts became really expensive. The option market was rushing to buy insurance. And now we could see all the different expirations, call it 7, 30, 60, 90, 180. How did those react? And now where are we right now? So right now we're back coming into sort of the the symmetric territory where puts and calls are about the same prices and we're around the zero line. So this is really a good idea if I have a bias on, like, let's say I think that spot prices are cheap and Bitcoin's going to go to 30,000. If I'm buying calls, am I sort of overpaying? And if I am overpaying, does it make more sense to create a put selling structure, or maybe some sort of butterfly structure where I can trade away some of that excess call premium? Or in the case of today, it's pretty much evenly priced. And so there's the opportunity to actually get long calls if you have an opinion on volatility being fairly priced, as opposed to selling puts. When we're back down here, puts were so expensive that there's such a demand for buying insurance that if you're willing to get long Bitcoin by selling puts, it can be a very profitable trade. Something else that we like to look at is the term structure. So one of the things going back up here, the smile changes based off the time until expiration. But if you look at the center of these smiles, this is going to be sort of the at the money term structure. And we can see how expensive or cheap different options are based on time until expiration. So if I go back here, again, let's look at that January 9th to today. Now we can see, okay, for fixed maturities, call it fixed 7-day, fixed 30-day, 60, 90, 180, how expensive is at the money volatility? So when things are breaking down, insurance is expensive right now because the event is right now. And we get this term structure that's called backwardated, where basically short-term options are more expensive in implied volatility terms than long-term options. Again, Luna event here, we see this huge spike. 3AC contagion event here, we see this huge spike. And now, not only are we relaxing, but we're getting back into this term structure that's flipping back into what's called contango, where basically short-dated options in implied volatility terms are cheaper than long-dated options. And so this is going to help you pick out your expiration. So kind of just to recap real quick, just the overall, what are implied volatility levels on a fixed standard basis? We look at Dval. Then what does the realized volatility of the asset actually do? How do we contextualize where it can go? We look at realized vol. Now that we have an opinion based on realized vol and the overall Dval index, now we want to look at the surface and pick out what expiration makes the most sense to structure my trade. And then where in that expiration, what strikes do I want to pick to structure that trade? And so you kind of have 4 opinions that you make there. And then lastly, you have your opinion on the overall market, if it's going to go up or if it's going to go down, or how much of a delta bias do you really have that you can overlay there. And then lastly, what I would do is I would scale into my positions and scale out of my positions. And all of a sudden, I've diversified my decision-making in a lot of ways. And even if I'm wrong on one assumption, I'm hopefully right on the other assumptions, and therefore can really minimize variance and isolate edge. So that's kind of how I think about my trading. This is how I use these tools. We have a bunch of different tools as far as like looking at FTX move contracts, some of these DeFi protocols. A lot of people like to trade the futures, trade the basis, use funding, stuff like that. So I'm happy to just kind of leave it there and kind of take it to the next step.
Wow, that was some a great walkthrough there, Greg. Really powerful stuff, and appreciate you doing that.
Yeah, absolutely. Thanks, Philip.
And then let me actually pull up my screen and share it here. So one of the other things that's important to us outside of building the tools and giving everybody kind of the the insights that we're building on the platform, we know that a lot of people like to work with data in its raw format. So we think building out kind of a different data access points for traders, give them with different levels of technical expertise, give them the ability to connect to our API, pull data, perform their own analysis on it. And so I'll kind of walk through some of the tools that we built out on that front.
Sure.
Let me make sure. Can you guys see my screen? Okay.
Yeah, we can.
Awesome. So GVol Pro members get access to a GVol Pro API Lite key, which gives them access to a handful of endpoints or data points where they can kind of analyze different metrics. So the URL on the screen that I'm sharing here is the documentation to all the endpoints. So we have information regarding options, some futures data, and then as we start to build out kind of the DeFi options data set, we'll continue to enhance and add additional data sets here. So for a more technically savvy trader who's comfortable connecting to an API in its raw format, all the documentation is here. And the nice thing about our docs is it gives you quick copy pasta examples where you could just take everything, connect it, drop in your API Lite key, and get off and running. But one of the things that we kind of know is Excel is the largest BI tool in the world. So instead of catering to just kind of the technical side, we've built out a lot of tools to support ingesting our data directly into Excel, where traders can just drop in their API key, pull some raw data, and we've got some prepackaged notebooks that we can share with everybody. So I'll kind of just walk through a couple quick examples. So we partner with a platform called Crypto Sheets, which will connect to our API. And essentially all you'll need to do is download a Crypto Sheets extension in Excel, and it'll allow you to pull in some data, drop in your API key, and basically consume data directly from GVol. So here's a quick example of a couple of the notebooks that we have built out, and all this data is accessible in Excel. So this is an example of just a raw spot price feed. So you'd be dropping your API key in here that's provided by us. You can kind of go in and flip through, if I'm on ETH, through the symbol that you want. And if you jump to the raw data, you'll see that the data is actually being fetched from our API and being consumed and dropped into here. So we pre-packaged some of these charts and analytics just so people can kind of get right in there. And then the raw data is always available to anybody that wants to trade it. And so that wants to just consume the raw data portion. So there's a few other examples of some of the charts and the raw data that gets output. So here's the volatility cone that Greg showed. And then we have some covered call strategies. So you can kind of pick, here's an example of Solana covered call data. So if we look into, let's go something longer. So we'll look at the Solana August expiration for the 43 strike. And then you can kind of see the corresponding data to if you were to be trading a covered call strategy. And so one of the nice things about Crypto Sheets is there's all these templates directly in Excel that you can connect to, pull all the data in, and everything's raw and ready to go. So you can perform additional analysis from the data itself. One of the other things that we think that we've built just to make consuming raw data a lot easier is we know that more technically savvy traders are focused on building systems around APIs in Python. So we've launched a GVol Python module. And with that, we've got a handful of prepackaged code base that people can just kind of same thing, drop their API key in and run this code. So I'll show you a couple of examples of some of those notebooks. And we can share these links as well. They should all be in our documentation. But this is a notebook that we've written that allows you to kind of analyze realized versus implied volatility. So if we actually just scroll through all the code, it'll kind of plot Bitcoin implied versus realized for a 7-day window, the variance premium, 30-day windows, with all the variables that you'd want to kind of toggle on between different exchanges, different currencies. And so now you have like a good clean code base for which you can start to add different features onto. But really the idea for us is to get you the things to get your systems up and running without having to take the time to build the systems from scratch. And so as you kind of scroll down, there's a handful of, actually, there's another notebook that we have here And this allows you to compare volatility across different assets. So we have the Bitcoin vol curve, ETH vol, Solana. And then as you kind of scroll through a bit more, you can see the vol fitted curve for Bitcoin, more metrics for each of the exchanges for specific expirations of interest. And so, and then again, across all the different exchanges. So bit.com, OKEX, and Deribit, obviously. And so as we're focusing on kind of building these tool sets out, making sure that these systems can get up to speed pretty quick for traders. We want to make sure that the data can be consumed in pretty much any format that somebody's comfortable with. And then we also provide a bunch of educational content for any folks who are not familiar with Python or Excel. On our YouTube, we have the GVol Excel tutorials, as well as getting up to speed in Python. And this kind of highlights going from 0 to, I wouldn't say 100, but getting up to speed as quickly as possible in terms of using the tools and the systems that we're building.
And one kind of note to add there is that what we charge $1,000 a year for this, but everyone who's a Real Vision Pro user gets a lifetime membership to GVol for free. And this is the only partnership deal that we've done with Real Vision. So all the Real Vision crypto folks are included in this and will have full access to all these tools that we've made.
That's fantastic. Thank you guys so much for partnering with us and extending all Pro Crypto members that awesome, really awesome lifetime membership. And we have a lot of, I think, technical people on the Pro Crypto side, so I'm sure they'll make full use of all those notebooks and APIs. So appreciate you sharing that, Pat.
Yeah, absolutely.
All right. Well, we have a couple questions from the community. So I'll just start with the first one. This one comes to us from Armanins, who wrote in, can you differentiate between puts versus calls in the block sniffer? And maybe before we kind of dig into that one, just walk us through exactly what a block sniffer is for those who are unaware.
Yeah, absolutely. Let me go ahead and share my screen again just to highlight this feature set. This is actually one of my favorite features, is the block sniffer. So basically, Paradigm is one of the big RFQ, which is request for quote, block trading platform. So basically, if someone wants to trade a multi-legged spread all in one big chunk, they go to Paradigm and then they request, they say, I want to trade this butterfly spread, give me a two-way market. And so a market maker will give a two-way market and they can either sell it or buy it. And so about 30% of the volume on Deribit is block trades. And so what we've done is we've created a tool set to look specifically at these block trades. So actually, if I look at Ethereum in the past, call it past week, we've seen a lot of interesting activity. So this is only going to be institutional folks for the most part. You have to trade a minimum contract size to be able to block trade. And so these are really people who have money or are managing other people's funds. And so theoretically, they have research teams and well-developed theses. And so with the block sniffer tools, what we can do is we can really see where are people trading. And so here, what we're looking at is everything that's positive is going to be calls. So everything that's positive is calls. Everything that's negative is going to be puts. And so we can see what people are trading right here. So if I just exclude this real quick, the bit just to make the chart a little less squished, you can really see people trading puts sort of out of the money puts and trading calls out of the money calls. And if I click back this March expiration, you can really see there's a lot of activity in these 35 by 4,000 by 4,500 strikes for March 2023. So a lot of this professional institutional money is trading sort of that call tail optionality, which is something really interesting to note. Now, if I go back here, I can also look at like what's the distribution of the types of trades by structure. So obviously there's a lot of outright calls. That's a big sort of percentage of the trade count. But then there's also call flies, call spreads, regular puts, strangles, straddles, stuff like that. And then there's a few other metrics, what hour of the day, what day of the week does Paradigm have most of this activity. But the idea here is I can really just look at this and get a really good idea of what people are trading. So that's kind of the block sniffer, and the way you look at puts versus calls is really positive versus negative as far as this chart goes.
Sweet. That's really helpful to know, to be able to look at how institutional investors and professional investors are managing their money and positioning themselves. So moving to the next one that comes from Benko Nation, asked, what sets your service apart from the rest, and what are your favorite tools that you offer? And Greg, maybe you already took us through a couple of those.
Yeah, definitely. So one of the things is obviously sort of the way you can ingest data, whether on the website or the raw format or Excel or Python. I think that's one of the ways that we've really set ourselves apart. But one of the other things is that we've created some proprietary tools from scratch that no one else really has. So we spent a lot of time figuring out trade direction, or the aggressor. Obviously, every trade has a buyer and a seller, but who's paying the spread is sort of the aggressor. And what we've done here is we've created a proprietary system that uses about 30 heuristics to really tease out who is purchasing, or sorry, who is the aggressor as far as a buyer or seller. And the idea there is that typically market makers are passive, they're updating bid and ask, and they're hoping that people will come and pay the spread. And so we've created this GVol GEX, which is basically gamma exposure, GEX. And so the idea here is that from a market perspective, from a market maker perspective, how are market makers positioned? And so the big distinction between market makers and market takers, for the most part, is that market makers are hedging away delta risk, and they're not really interested in making directional bets. Whereas the rest of the public has a multitude of reasons to trade options. And so if we know where market makers need to hedge, what we can see here is basically all the different strike prices. And this will tell us, okay, for example, at 25,000, for every dollar change in Bitcoin, the market maker has to hedge 0.64 of gamma. So if Bitcoin's going up, the market maker has to buy, market makers as a whole have to buy 0.64 Bitcoin to stay delta neutral. If the market's going down, you have to sell 0.64 Bitcoin per dollar. So it really gives us a good idea of how the market makers are positioned and how a lot of the hedging flows are going to come in. And this took a long time to develop. The real secret here is having a really accurate picture on the trade direction. And in the long run, what this will tell us is that in the futures market, where the hedging flow is going to happen, and as the options market becomes a lot bigger versus the spot market, this will eventually start affecting spot prices as market makers have to buy or sell underlying to hedge their books.
Sure. Yeah, it's a great tool there to be able to see the gamma levels, and I love how you explained how much they'll have to sell or buy based on that gamma position. So moving into the next question from Badoj, who asked, in what ways do crypto volatility analytics signals resemble VIX volatility analytics signals, and in what ways do they differ?
Yeah, so I would say the ways that they're similar is that every asset class has sort of a volatility surface, sort of a typical skew level, a typical term structure. So that kind of is similar. The big difference with crypto is that the amount of sort of volatility of the volatility itself is really big. So like, for example, if I just go back to June, here's 7-day at the money vol. So when we talk about like S&P 500 vol, the VIX index right now is about 22. So that's telling us 30-day options have about 22 implied volatility. And the highest I've really seen the VIX is like at the peak of the pandemic was around 80. In the financial crisis, I think it was around 70. If we look at Bitcoin implied volatility, I mean, we were at 59 and then we hit all the way up to call it 189, 200 plus for 7-day options. So the volatility of volatility in crypto is a lot bigger. And then sort of the how much the skew shifts around is a lot bigger as well. So if I just go back here, let me just go back a whole year just to really get you a good idea. So here I'll be looking at sort of 35 delta calls. And we can see here, again, looking at equity options puts are just always more expensive. Equity index puts are just always more expensive than calls. If I'm looking at Bitcoin, we have like a huge variance. We can see like at this point in time, and actually let me go back a little bit farther because I remember that April 2021 was insane. People were FOMO getting long options. And so we can see like, let me stick the zero line here. We can see that the relationship between what's more expensive, puts or calls, isn't fixed, and it actually changes a lot. So in this area, calls were just more expensive than puts. Then we had this sort of this meltdown and puts became more expensive. And then we had this recovery and calls became more expensive and so on and so forth. And now we're kind of back to the zero line, trying to figure out where we're going. That relationship in equity index, for example, never shifts like that. It's almost, we never really see calls way more expensive than puts. We might see the amount of excess cost to puts being less or greater than the average, but it's almost always true that puts are more expensive than calls and equity index options. In crypto, that's not the case. And that really brings me back to kind of my earlier point that the vol surface hasn't been figured out in crypto yet. Not only can people not really, it's almost impossible to know what crypto will be worth in the long run. Now add the complexity of like, well, what, if we don't know what it should be worth, we don't have like PE ratios and price to book ratios figured out. How do we know how the volatility of crypto should be priced going into the future? The time series of crypto, like what happens day to day, is kind of up in the air. We've seen the pandemic in March 2020 have a huge spike down. We've seen a massive price rush up in many crypto cycles. So the volatility surface shifts a lot more.
Sure. And moving into our fourth question here from Moon Bandit, asks, is there a means to see a time series via chart changes to open interest and skew?
Yeah, so the skew chart, this is the one I'm looking at right here. This is the time series of the skew. And then if we want to look at open interest, we actually have a really cool global page. So if I just want to look at how open interest changes over time, whether I'm talking about Bitcoin, purely Bitcoin, or Bitcoin versus ETH open interest, so on and so forth, I have a bunch of charts here. So here's going to be the open interest over time. So if I just want to go back to say the beginning of the year, I can go ahead and do that. Now we'll see notional in millions of dollars of open interest for Bitcoin. We have it broken out by all these exchanges. We include DeFi exchanges, which I think is a really exciting component. So we could see basically here, 7.5K millions, 7.5 billion. And we can see how the open interest changes over time in notional terms. We can also recast that in normalized one contract terms and see what that looks like over time.
Very cool. And our final question, which is also from Moon Bandit, asks, can we get a breakdown on what squeeze is and how to read it?
Yes. So squeeze is a super interesting, they call it a power perpetual. You can also think of it as an everlasting option. And the way that squeeze is priced is basically we have a mark price and an index price here. So index price is really ETH price squared. And so squeeze attempts to have the convexity profile of ETH price squared. And so what they're attempting to do here is that squaring a bigger and bigger number has this parabolic upside, whereas squaring a smaller and smaller number has this concave like downside. And so, or decreases at a decreasing rate. And so what we have here is the ETH squared index price. The mark price is going to be the theoretical squeeze price. And so you can see there's a small premium in mark versus ETH squared. That difference is going to be sort of the premium you pay over the index to get that convexity profile. Now, the price of a squeeze token is going to be the mark price divided by 10,000 times the normalization factor. So the normalization factor, the way you got to think about it is that when you're buying option premium, you're paying some premium up front, and then at some point those options expire. In Squeeth never expires, but the normalization factor is sort of the decay factor. And so Squeeth has a 17.5-day theoretical cycle, and that's how you calculate implied volatility. But basically, the smart contract itself, every time there's a touch to it, it'll start pricing in that normalization factor. So Squeeth is, call it maybe like 10 months old, something like that. And since inception, the normalization factor started at 1.0, 100%. And over time, the decay factor, once Squeeth has decayed about 48.5%. And so that decay is going to be sort of the implicit premium that you pay for that convex exposure. What we've done at GVol is we've calculated the implied volatility of Squeeth. So you could see basically implied volatility is about 95. So it's actually really in line with the options market. Here's just the raw Squeeth price for the past 24 hours, 169, and then ETH dropped a little bit. Now that's 154, so on and so forth. Here's the delta profile. We also have a gamma profile, a vega profile, and a theta profile, so on and so forth. And then here we can see like the volume on Uniswap of Squeeth tokens, or the dollar value of Squeeth traded volume in the past 24 hours, pretty much. And then we have just like the index and the historical funding, so on and so forth. So that's pretty much the gist of Squeeth. It's basically a forever option that has sort of a decaying normalization factor in lieu of premiums paid.
Very interesting. Well, that was all our questions from the community. I don't know if there's anything either of you would like to add before we sign off for today.
Yeah, one more thing that we do have is we have a newsletter. So if anyone's interested in sort of our weekly commentary, so we genesisvolatility.substack.com. If you go over here, we have a weekly newsletter that we do for kind of our views on the market, what we see vol doing, so on and so forth, like big flows that we like to note. And then we touch a lot on the vol surface. We also have a bunch of stuff on block trades I went through for the week. And we actually do have a section on Squeeth as well that some of the Squeeth team provides for us in our newsletter. So there's a lot of kind of insights that the vol traders in the crypto space might be interested in learning about as well by following this newsletter.
Absolutely. We can share a link with the Pro Crypto community, because I think they'd get a lot of value out of that one.
Cool. Well, thanks so much, Philip.
Yeah, thank you guys. Really appreciate it. Really informative stuff.
Awesome.